Hello everyone and welcome to This Week in the Markets. This week we turn our focus to central banks action, in particular the Fed and the ECB, and we'll also discuss the effects of their actions or lack of on various asset classes. And we'll do that right after this disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial conditions, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial conditions, and needs. So last week, there were growing speculations that central banks would act soon to stimulate the economy. Firstly, we have the Jackson Hole conference where traders were expecting to hear from Fed Bernanke to give more details on how the Fed would stimulate the economy, just like he did in 2010 before he initiated the second round of quantitative easing. As we expected though, he did not offer much details and merely reiterated what had been said before, that the Fed is prepared to act as needed to provide support for the jobs market. However, the market did give Bernanke credit for his use of words such as grave concern to describe the jobs market, as it reflects his ongoing concern for the employment situation in the US. The Fed will meet next Wednesday and Thursday in its monthly interest rate decision meeting, and we still highly doubt that the Fed will initiate another round of quantitative easing straight away, but much of that will also depend on the non-farm payroll on Friday. Currently, the consensus is 427,000 new jobs in August. If the non-farm payroll meets these expectations, then it is quite unlikely that the Fed will rush to take on any more actions. If jobs falls below 100,000 and lingers between 80 and 90,000 levels, then there will probably be more urgency, but still unlikely for any actions to occur. Perhaps the Fed might step up on more threats for stimulus if this occurs, but we don't think that they will take on any actions. We think the only situation that could push the Fed to ease this month would be if jobs growth falls below 50,000 or even contracts for the month. Fed Lockup put it quite clearly last week that when he said that the easing decision would be much easier if jobs growth were anemic or if there were signs of deflation. As it is now, the US economy is not weak enough to ensure unlimited easing by the Fed, but at the same time it is not strong enough either for the Fed to just leave it alone. So we expect this jawboning by the Fed to continue a bit longer until the economy emerges from either side. The European Central Bank will be meeting later tonight, and Mario Draghi has set a strong expectations that the ECB will begin a bond purchase program this month. Last month, Draghi pledged to do whatever is needed to protect the euro, but fell short of delivering an actual program, stating that time is needed to set up the infrastructures required. On Monday, he dropped more hints that the ECB is ready to help Italy and Spain to lower their borrowing costs, as he said during a closed hearing at the European Parliament that the ECB would be open to buying bonds with maturity of 2 to 3 years. And more importantly, he stressed that it would not break the European Union treaties to do so. He also skipped the Jackson Hole conference last week where central banks meet, as his spokesman cited that heavy workload is expected leading up to the ECB rate decision meeting. So all this is pointing to an actual implementation of some sort of bond purchase program when the ECB meets tonight. And we'll be very surprised if the ECB actually fails to deliver again, because Mario Draghi has so much of his reputation at stake this time. If the ECB does engage in some sort of asset purchase program, one asset class that will probably benefit from this is gold in euro terms. We can see from this chart of gold in euro, it broke out of a long-term consolidation pattern last week, and that's because of the increased speculation that the ECB and the Fed will ease policies even further in the coming month. If the ECB does start its bond purchase program, it could boost the value of gold, while at the same time, euro may get diluted because of an increased money supply, especially if the ECB engages in non-sterilized purchases. So we expect this to be one asset class to benefit from the ECB's asset purchases. We also think that the British pound would have much to gain if the ECB steps in to lower Italy and Spain's borrowing costs, as this would help to stabilize the conditions in Europe in the short term. And other than the Eurozone, the United Kingdom will probably be the one to benefit most from this program. Unlike the euro, however, the pound will not be devalued due to the ECB's asset purchases, and so its currency will probably have more to gain than the euro. In particular, we like the chart of pound against the US dollar as it seems to be building up strong bullish momentum. It broke out of its 3-month consolidation a few weeks ago. It retested at 1.58 level for support and made another breakout yesterday. And we also see a potential for long-dated US Treasuries to fall if the ECB steps in with more easing measures. Not only would this decrease the demand for safe haven assets like US Treasuries, but if the ECB does announce that they will put a cap on Italian and Spanish bond yields, it will make European bonds more attractive for bond traders. And so we might see a switching effect out of US Treasuries and into European bonds. Moreover, US Treasuries rallied quite strongly last couple of weeks, mainly because of an increased speculation that the Fed will initiate another round of bond purchases in US. As said earlier, we think that this is quite unlikely unless the US economy really deteriorates quickly in the short term. Therefore, we think that both factors could push US Treasuries lower and yields higher if the ECB does engages in bond purchasing. So this will be good to keep on the watch list for tomorrow after the ECB rate decision meeting, and we can see how the trend goes there. And that's all from us this week. For the coming week, we could expect quite a bit of volatility as we wait for announcement from the ECB tonight and the non-farm payroll report tomorrow. Trading volumes have also picked up as traders return from their summer vacations, so the quiet consolidation period will probably be over quite soon. And we'll have another update for you next week. Until then, on behalf of the Trading Pursuits team, we wish you all a profitable trading.